Hi, my name is Jason Dufresne,
And I'm Blake Roderick.
and our project is on forecasting interest rates. The following rates for our project are forecasted on the 1-year rates 1 year from today, and 1-year rates at a specific point in the future. We have tracked these rates and the change in these rates due to current event changes in the market between the days of October 27, 2014 and October 31st. This graph depicts the changes in rates between Monday and Friday. There have been many changes in the market and current events that cause these rates to fluctuate. And at the 10-year market shows the most volatility, but we know this is due to artificial changes in the rates due to the Fed.
The graph here shows the change between Monday and Tuesday. As you can see, the rates have not changed very much. This is because there have been a lack of activity in the market and there have not been any major current events. The graph on this slide shows the changes from Tuesday to Wednesday. The rate changes are because the Federal Reserve has announced that they will stop quantitative easing. They will end their monthly bond buying, causing the supply of money to fall. When money decreases, the demand will rise, causing the prices to rise and causing the short-term rates to fall. Without quantitative easing, the best choice for investors will be to move cash from short-term to long-term. This can have a great impact on the yield curve.
On Wednesday's yield curve, with the Fed's decision to end quantitative easing, many investors will shift their long-term investments to the long term. This will drive the price up and the rates down, which causes the yield curve to flatten overall. And the next graph is between Thursday and Friday. On Friday, Japan released news that they're going to start to buy large quantities of their own debt. This will increase their money supply and ultimately decrease the value of the yen. With the value of the yen decreasing, this plays an important role on the U.S. economy, and this causes a greater demand for United States dollars, and also the value of the dollar will rise.
With the devalued yen, there will be an increase in demand for the U.S. dollar. This will have a great impact on the overall U.S. markets. It will cause a change in the overall bond markets. The demand will rise, the prices will fall, and the prices will rise and the rates will fall.
With Japan's decision, many of the investors foreign investment in the United States will just grow and cause all rates to drop because the demand has risen, which will ultimately cause a dropping yield curve and a flattening yield curve. So throughout the week, there have been two main things that have caused the yield curve to flatten. The Fed ending quantitative easing, which make the investors move their money to long term, which will drop the rates, and then Japan's decision to increase their own money supply will ultimately cause a greater demand for U.S. securities and drop the rates. This yield curve graph depicts the yield curve throughout Monday through Friday and shows a flattening in the long term.
In conclusion, the recent events have caused a few things. Short-term securities will have a greater demand and a greater price, and the rates will fall. Long-term securities will have a relatively higher return because the rates will be higher. As an investor, you should move your money from short-term to long-term to capitalize on the higher long-term rates.
Thank you for your time, and this concludes our presentation.